The Fed cut the federal rate by 50 BP or 0.5% interest rate, but the market still dropped 785.9 points. Why? Let's say a smart, clever kid keeps asking for candy to his mom. The mom is the Fed. Because mom keeps giving candy when the kid cries, now the mom is worried if there is enough candy remaining. Mom starts to save candy for the future, and the smart kid realizes that he can cry to get more candy. One day, when kid is crying for candy, mom grabs the candy, but she sees that the kid is laughing. Mom realized that the kid is playing and that he is clever enough to cry on purpose to get more candy. Since the kid is crying and the mom just watches him, the kid starts to bang his head against the wall. Mom was surprised and grabs the candy, and the kid asks for more candy than the mom plans to give. It is very burdensome to the mom, and the mom decides to ask her friends for help. The kid is now really happy, because not only can the mom give candy, but her 7 friends will give presents as well. The kid expects the huge presents, but ends up with only 2 candies from mom. The kid is very disappointed for only 2 candies. Late week of February 2020, the stock market sharply went down, causing trillions of dollars to be wiped out, and the market panic to ensue due to the coronavirus. Market reacts aggressively by selling off the stocks like a kid banging his head against a wall. And because the Fed is just watching and doing nothing, it is worse. The market watches the Fed's reaction and expects that they will do something. Early March 2020, the G7 conference meeting was held, and they discussed economy headwinds that imply that they will work together to resolve the problem. Globally, they worked together, and that caused great news to the market. The market thought the Fed would do anything other than just watch. The market experienced the Fed doing action to support the market when big headwinds occurred. For example, in January 2008, for the subprime crisis, they held an emergency Fed meeting and cut the rate by 0.75 BP. A few days later, another 0.5% at a regular meeting held 8 times per year. In June 2016, British exited the EU and the stock market crashed, and G7 announced that they will supply an unlimited amount of money if something were to happen. After that, the stock market recovered within a week. In 2016, when Chinese faced the bad economic data, G20 and central bank financial minister held meeting at Shanghai to address the issue. In 2018, the Fed announced they plan to increase rates gradually to 2019 due to the strong US economy. But in 2018 December, Fed suddenly changed their plans. Why? That month repo rates shot up. A repo is when one party lends out cash in exchange for a roughly equivalent value of securities, often treasury notes. This market exists to allow companies that own a lot of securities but are shorter on cash to cheaply borrow money. That difference in price determines the repo rate. That month, junk bond market issued 0 bonds because nobody wanted to buy them. The Fed can see that might spread the credit crisis. The Fed is just a step inflow the capital to run smoothly. Repo market is very sensitive when capital is dried out that will cascade to destroy the entire market, including gold. When capital is dried out, gold that people think will be safe will also drop, as similarly what would happen in the subprime crisis of 2008. Fed's Vice Chair Clarida commented about the mirror room, and it well reflects the Fed's stress. When you are in front of a mirror, you and the images are acting together. This means that bond market rates drops because the market predicts that the Fed will cut the rate. The Fed thought, why aren't bond rates down? Is there any bad news that I don't know? What's going on here? Well, I don't know. Anyways, let's drop the rates, then think. What this means is that the market is leading the rates. The market will drop the rates and will wait until the Fed follows. It explains why we have such a long bull market. When market news is bad and have poor data, the Fed will jump in to increase the inflow of capital and the market goes back up. Because the inflow of the capital is subdue the bad economic data, the inflow capital is the best news compared to any other. Simple Econ 101. If there is more money, the price will always go up. On the other hand, if the economics is booming, the stock market goes up. Even the rates is increased. Markets believe and experience that Fed will always jump in to save the harsh market. What does that mean? Bad news is good, good news is good. Bad news is good, good news is good. Doesn't matter. How long will this loop sustain? Fed is getting out of candy. This time, markets expect big presence, which will be the G7 involvement, not just in one country's rate cut. Because globally they work together and they expect the best for the market, they will lead things to the best direction. But Monday's results is disappointing to the market.